Hi, Christian, great to see you. Let's start with pricing the Fed, which has been all over the place. We've gone from 6 rate cuts to now none, now the outside chance of a possible rate hike. What are you anticipating, and how is that potentially going to impact private credit strategies?
Thanks. We're still anticipating that it's likely that we'll see a cut this year. It may be as late as December, but it's likely that we will see a cut. It's even possible that if we get another couple constructive inflation prints like we just had last week with the April inflation, that we could see a cut as early as September and then another one in December. But that's probably the best case scenario, that we see those two. A hike we think is unlikely. We see monetary policy as restrictive now. It is taking some time for that restriction to come through the system, but it is happening, and we're starting to see it in some of the employment indicators and some of the inflation indicators, and we see that progressing over the course of this year.
It's interesting, though, isn't it? Because you look at the Fed speak and you hear the minutes, they just keep pushing back on expectations of an easing cycle. And it just feels like they need more data to confirm that inflation really is on a moderating trend. So arguably, have we really seen the worst of bond market, rates market volatility?
Well, we probably have seen the worst. Last year was a significant period of interest rate volatility when expectations were very high around the Fed cutting rates. So that worst is probably over, but we'll be in a range of the 10-year Treasury. It could go down to 4%, it could go back up to 4.75, that kind of thing. But actually, if we settle down into that range, that's probably healthy, where the market starts to realize that inflation could be higher for longer, and that will lead to rates being higher for longer. But it seems unlikely that inflation would break out to the upside. We are seeing a moderate cooling in the economy, which will ultimately bring a moderate cooling in inflation and keep some of that volatility, that extreme volatility that we saw last year, from happening again.
What's the shape of the yield curve telling you?
Well, the shape of the yield curve is telling you that ultimately the Fed will win, that ultimately the Fed has credibility, and ultimately that inflation will come down. And we think that's a very reasonable base case scenario.
When you consider the environment for private credit in the United States, there's been fears of a bubble, there's been fears of a possible implosion, something going wrong. Yeah. Are those fears misplaced or realistic?
Well, I think a bubble and an implosion are probably a little too much. But the reality is that right now, the IMF had a really good report a couple weeks ago, and said that about a third of private credit borrowers, as of right now, have less EBITDA, less income coming in than they need to cover interest, taxes, and bare minimum maintenance capex. That's a lot of companies that are essentially burning cash right now with the economy as strong as it is. Now, the other side, though, is that the economy is quite strong. And so you see this, that margins are high and in many cases getting even higher. And so, with the economy as strong as it is, that does give a lot of leeway for some of these stressed private credit borrowers who are faced with a very high interest burden to be able to make it through. But it is important that you'll see ultimately rates come down, because many of these companies are paying effectively a 12% interest rate when they thought that they were going to be paying something like a 6% interest rate. And so, that 12% is just unsustainable over the long term, especially assuming the economy will ultimately cool down.
Are we out of the woods in terms of the stress related to commercial real estate?
No. What is happening is that we're in a long cycle in commercial real estate where it is going to take some time for the defaults to emerge and for that stress to work all the way through the system. We're probably out of the woods in terms of extreme impact on regional banks, and so that's the good news. But the bad news is that there's still a wave of maturities coming in commercial real estate debt, and it is going to be very difficult to address those maturities.